Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content at Deal Catalyst. Joining me today is Yann Robard, managing partner at Dawson Partners. Yann, it's great to see you. Thank you for your time. Looking forward to our conversation.
Thank you for the invitation. Appreciate it.
So, to kick off with, for those who might not be familiar with Dawson Partners, can you give us maybe an overview of what Dawson Partners is, and ultimately, how did you come to the idea of the firm?
Got it. So maybe we can start in 2001. But I will start in 2001. So actually, I started my career with I always like to start with a Mexican furniture store here based in Toronto. I always say that because I've always had kind of entrepreneurial blood flowing through my veins. And then after that, I kind of spent 15 years at the Canada Pension Plan Investment Board. And that was almost like an entrepreneurial experience with institutional support. In the way that when I joined CPPIB, there was 24 people. 15 years later, I left, there was 1,200 people. We went from 7 billion to 285 billion under management, and they fed my entrepreneurial spirit by allowing me to build businesses. So they started with go build the funds business, and then I helped build out the London office, and then started a secondaries business within CPPIB, and then a co-investment business. And then 15 years later, it was 2015, I was turning 40, and I got on this infamous bike ride between the Yukon and Alaska. And it was on a bicycle. And I was asking myself, like, what do I want to do when I grew up? I was turning 40 at that point in time. And it's on that bike ride that the idea of Dawson, which, by the way, was the midpoint of that bicycle journey, came to life. And I wanted to go back to my entrepreneurial roots at the end of the day. And the whole concept of Dawson on that bike ride was, okay, look, in private equity, if you want to generate liquidity on a private equity portfolio, you really had two options. You could go to the leverage market, to the banks, and you could use leverage to leverage your private equity portfolio on a diversified basis up to 30 to 40% LTV. That would have a cost of capital of around, depending on the environment, 8 to 10%. Or you could go to the secondaries market and sell your private equity portfolio to the established secondary players. You would do that for about 85 to 95 cents on the dollar, and the cost of capital there would be about 16 to 18%. And we were sitting there saying that can we sit in the middle and provide essentially kind of a structured solution, provide a new tool in the tool set for private equity investors to allow them to accelerate liquidity on their private equity portfolio, but keep the upside, keep the flexibility, and keep the relationships with their GPs. So that's really what we kind of came to be. And that, was about 10 years ago. It was actually just a little bit over 10 years because we just celebrated the decade of Dawson. And in a short period of time,
congratulations.
thank you so much. It's been an incredible ride. I'm pinching myself way beyond my wildest expectations, what we've accomplished. And yet we also feel like we're just getting started. In 10 short years, we've kind of exceeded now 25 billion of assets under management. We've got offices now in Toronto, New York, and London. We've got 250 people at our firm. And it's just been an incredible journey. And I think I always say the secret to my success is I don't know what I'm doing. I've never done this before. And so you're always kind of learning every day in terms of being able to take best available information and make the right decision in that time for what you know. And mostly it's about just having great people. I'm sure we're going to talk about culture at Dawson, but that's something that's very near and dear to my heart.
So, private markets obviously look fairly different today from a decade ago. How has your strategy evolved as private markets have become more mature and obviously, competition has increased a fair amount in the last decade in the private space?
Yeah, so the way that I would just try and summarize it is we've been focused on tech first, tech enabled, tech focused. We've been focused on innovation. We've been focused on creating scale, and we've been focused on culture. Really, that's really as private markets has kind of continued to mature and expand. We can talk about the nuances of how we've actually kind of continued to build our business, but it really comes back to those four factors. So first and foremost, tech matters. I
Yeah.
think one of the things that I have my mentor, my coach, is the ex-CEO of CPPIB. And when I first started this way back in the day, I asked them, what would you have done differently? And the answer has been like, focus on tech. Because if you don't focus on tech, what you're going to have is 25 software systems. They all say they're going to talk to each other. They don't. And so we were really focused back in the early days at Dawson, in the first couple of years of building a tech stack that was fit for purpose, that was going to be able to grow with the complexity that we have. And so, in today's market, data is power.
Hmm.
But data is only power if you can actually extract it, analyze it, mine it, and then turn data into information and information into insight. So for us, we have been very tech focused since the very beginning. We're really proud of the proprietary tech system that we've been able to build internally, and that has enabled us to create a system that we call Dawson Alpha, and that allows us to be more resource, more sophisticated, more informed in how we actually kind of look at the underlying investments because we've got the data to be able to do that, and then we got the systems to be able to extract it. So that's one, tech. Two, innovation. I would just say, from our perspective, what's really interesting is you can never be kind of a full step ahead of the market. You want to always just be half a step ahead of the market. One of the things that we're proudest of in this whole journey is that, we've always been kind of getting feedback from the market in terms of when they were ready for the next evolution. It can't be a revolution, it's got to be an evolution. And sometimes if you're too far ahead of the market, you're going to be banging your head against the wall, and then you step back and there's a door right there. And so
Yeah.
for us, it's always been about pivoting and adapting and listening to a market feedback as to whether the market is ready for that innovation to be able to take part. And that's really what's created our scale at the end of the day, because scale has allowed us through innovation to become more sophisticated, and through sophistication, being able to generate, what we believe to be resilient returns for our investors. So we got tech, we've got innovation. Let's go to scale. Scale matters in this market. I think that's
Yeah.
one thing that we are so focused on in terms of, we've been unapologetic about our growth since the very beginning. We say that big is beautiful, growth is good, and scale matters. And the reason behind that is really kind of fourfold. One, in creating scale, what you can do is actually have the capital to provide execution certainty for our counterparties to be able to move in size, in scale, and in speed. And that allows us to differentiate ourselves in the marketplace and differentiate ourselves in terms of being able to be one of the few providers of these structured solutions at scale. Two, scale matters because of data. As the bigger you get, the more data you get at the end of the day. Three, scale matters because once you have that data, you need to have the size of a management company to invest in your technology to be able to extract and analyze it. And then four, scale matters in terms of the people. Because I always say if your organization isn't growing, then you've got glass ceilings. If you've got a growing organization, and I saw it at CPPIB, essentially you're able to almost like create your own path within that organization. And that provides a lot of opportunities for people within Dawson at the end of the day. And that's something that's near and dear to our hearts because then it's like the type of people that you're able to attract into your organization, the ability, the hungry but humble, the entrepreneurial spirit, the intellectual compensation that you're able to provide them, that matters at the end of the day. And then it goes to culture. I think that's
Yeah.
something that's so near and dear to my heart. We like to say that there's no superstars, there's no egos at Dawson. We're hungry but humble, in it together, stronger together. We believe when you give, you get. When you do good, good things happen. You can be a good person and win. And all of that really matters in the DNA of our firm. It's not just what we do, it's how we do it that gives us great
Yeah,
pride.
I mean that is always as you scale, do you feel as if you lose some of the culture? And clearly you don't think that you've lost the culture. And how do you do that as you scale to 25 to 250 people? I mean, that's a vast difference between the two.
Yeah, and for us, it's simple. You measure it, and so when we say we measure it, the way that we do our performance reviews at Dawson, it's not just the what you do, it's how you do it, and that's so important. So the way that we actually measure it was on the what, you're either not good, good, and great at what you do, 0, 1, 2. On the how, you're either culturally inconsistent, culturally consistent, or culture carrier, 0, 1, 2. And you're marked out of 5. So there's an exceptional box above that. But if you're, great at what you do and culturally consistent, that's a 3. You're moving forward. If you're a culture carrier and good at what you do, that's a 3. You're moving forward. But if you're great at what you do and culturally inconsistent, or if you're a culture carrier but not good at what you do, you don't move forward at Dawson. And so we are very intentional. What I find really surprising is as you get into calibration meetings, and we do this twice a year at Dawson, it is so quick. The consensus builds in terms of where people are at on the how. And so, and it's not to say that our culture is the right culture and there's a wrong culture. It's just to say that we know what our culture is at the end of the day and that we want people to operate within that culture. Not good or bad, not better or worse. Different people flourish in different cultures, but we know the types of people we want within our culture that allows us to succeed as Dawson.
Is that one of the things that you think other firms, fail at is, they say they have culture, but do they really have culture?
I mean, I think there's a difference between saying it and living it.
Yep.
I don't, do other people stumble around that? Perhaps, I think you gotta really focus on not just saying the words. You got to remind people consistently the way that we do. We do have 2 offsites a year. We bring everybody together. We allow people to kind of get to know each other informally and formally in those sessions. But it's
And it
just like
starts at the top too, right? I mean, if
yes,
you're not living it, your employees aren't going to live it, right?
yeah, and it's okay. Like we are so lucky to be in the seats that we are in, and so my whole thing is always like stay grounded, stay grateful. We're living in a little bubble here. And so we
Yeah.
just need to be aware of how lucky we are to be in the seats that we are in and never allow yourselves to your head get too big. So constant check-ins to make sure that you're remaining grounded and grateful on this journey. I pinch myself every day. Like this is way beyond my wildest expectations. What's like accomplished here. And I think there's a difference between, I don't think this was what the podcast was about, but we're going to go down this path. But there's a difference between
Goes where it goes.
arrogance and conviction. And I think
Yeah.
arrogance comes from an unhealthy place. And I think conviction comes from a healthy place. And so we have tremendous pride in terms of what we've been able to accomplish at Dawson. And yet we're just getting started. And that comes from a place of conviction, not arrogance, if that makes sense. And obviously, I'm
Yeah.
saying all these words, so the external audience will determine whether that feels, from conviction versus arrogance. But
I
that,
can tell you in hearing you say it, it doesn't come off as if you're just saying the words. It
yeah,
comes off as if it is part of your ethos in what you're saying. And I think that's obviously what you've strived for is that it's not just words on a piece of paper or words that you're saying through a screen. It comes off as if it is part of ingrained in me, ingrained in the firm, ingrained in our people.
thank you. I'm not good at taking compliments, but I'll take that one. But I also think that the culture doesn't also, you say it comes from the top down. There's some elements of that, but it also comes from the bottom up. And so actually one of the things that we're really mindful of is just very quickly as we kind of do the what and the how within our organization, also identifying, where places where the how might be kind of a little bit in a different place than where we want to be. And just constantly reminding people like this is how we want to show up. This is, how we want to do things. It's not just the what, it's the how. There's no I at Dawson. Every time I say to somebody, great job, the answer is always like, it wasn't me, it was the team. Right. And that's what we're looking for. We're looking for moments of, cultural shifts that are so important.
So if we move to the capital side of the equation, um, how should institutional allocators think about private equity today, and has that risk return equation shifted in recent years, and especially today with all the noise happening in the market?
Yeah. Um, so much to say about this one. So let me try and start with like the historical lesson on private equity is that over the past quarter century, private equity has outperformed public markets. We really
Yeah.
strongly believe that, right? If you take $1, you invested it on January 1st, 2000, by December 31st, 2024, that dollar, if you would have invested in a Russell 3000, would have gone to 6.6 times money. Not bad. In private equity, 19.9 times. Okay, so there's been 3 times more wealth generated in private equity than public markets. It's compounded, right? And private equity has generated, 13% net IRRs, where public markets have generated 8%, right? That's what's caused this outperformance.
Yeah.
Needless to say, the last 4 years has been challenging on private equity. If you look at the last 4 years, private equity has underperformed public markets by a pretty significant margin and also has generated almost half the amount of historical liquidity that it has over the past quarter century. And the numbers behind that is it's generated about 14% of NAV over the last kind of 3 or 4 years, where the historical average has been about 25% of NAV that you would have gotten back in distributions in a mature private equity portfolio. So it's easy in the eye of the storm to lose faith in this asset classes. And anytime you go through a period of more muted returns, and we saw that in 01 and we saw that in 09, and we're seeing it here again, it's easy to say, well, private equity's heydays are behind them. But I just fundamentally feel differently.
Mhm.
And I kind of look at it and say the real power of private equity at the end of the day is its governance model, right? I go back to like, if you look at public markets, 70% of public markets are computer traded. The 30% that aren't, the folks that are looking at the fundamentals, which are few and far between, they're looking at quarterly earnings and how do you build a better business around building a business off of quarterly narratives? It's really tough, right?
Yeah.
Private equity, on the other side, has long-term patient capital, 3 to 5, 6, 7 years in order to do what it needs to do with that underlying private equity company. And it's got a concentrated, aligned, sophisticated shareholder that is really focused on building that better business. So for me, it all kind of came to light. That's an unquantifiable, right? But for me, it came to light on Liberation Day, on April 2nd, when the markets got shocked by the terrorists. That next day, every GP was on the line with their portfolio companies saying, where are you weak? Where are you strong? How can we help? How can we enable? What's your liquidity position? We're here to support. I'm not sure a lot of public companies got that call, right? And so for me, that is kind of the crusp of private equity's ability to generate alpha. Now you go to the next stage, and we're going to like there's software that's in question right now. There's a lot of discussion around AI at the end of the day, and I think once again, like, do you want a concentrated shareholder that's sophisticated, that can hold your hand, that can provide value add in terms of how do you navigate? I'm not even going to talk headwinds and tailwinds. Right now, there's swirling winds
Yeah.
everywhere, right? And so as a CEO of a company, would you benefit from having access to a shareholder that's there and aligned and saying, how can we help? How can we support? Right at the end of the day, I think that is the unquantifiable of private equity. And I think that, as we kind of look forward, acknowledging that the last 4 years have been difficult on private equity. When you look at why public markets have outperformed private equity, what we have found is that the Russell 3000 went from about 12 times EBITDA to 16 and a half times EBITDA, a 4.5 turn kind of increase in terms of multiples. So this has been the valuation increase has been multiple driven, right? Private equity has gone from 13.9 to 14.8, so less than a turn. So there's been more valuation discipline in private equity. And when you look at the fundamentals, our analysis suggests that LTM EBITDA for private equity has been consistently between 10 to 13% from 23 to 25, whereas public markets has been between 0 and 10%. So more resilient, stronger EBITDA growth, and yet now being held at 1.7 times discount to where public markets are at. At some point, that reversion is going to happen, and that's going to revert and provide tailwinds to private equity to generate excess returns versus public markets. So this is my thing for what we believe anyways, is that be careful when you go through market lulls, when you don't want to miss out on that recovery, in private equity. Because if you miss those important vintage years, and that's the lesson you've learned as being a private equity investor over the long term, is you miss like a 2006 or a 2021 where returns in private equity were significantly in excess, and that's going to hurt your long-term returns in private equity.
One thing you said there that I think I picked up on was, if you're a CEO, what type of shareholder would you rather have? And the lack of companies going public, does it come back to some of what you were saying, patient capital, the right partners? And if I go public, some of that changes and evolves, but if I stay private, I can work with the right types of partners. Has that also led to less companies wanting to go public and staying private longer?
So, I mean, public companies have gone from 8,000 down to 4,000, right?
Yeah.
And private equity and private capital has increased from 5 trillion to 20 trillion, right? There is a reason why capital is flowing towards private markets, right? And so, look, I think that there is a role for both markets to exist at the end of the day, but we can't lose sight of where the capital is going and why there's fewer companies in the public markets. But I do think that it kind of comes to an interesting point. Like private equity, serves now, I think, almost two purposes in a portfolio. It used to be that private equity was there to generate alpha, and I think it still can.
Mm-hmm.
But in a world where public markets are becoming increasingly concentrated, the Mag 7, everybody's talking about this at the end of the day. Private equity's role could not only just creating alpha, it could be a diversifier to your actual portfolio. Equity is equity. Maybe we stop talking about it as an alternative asset class and we just talk about public and private equity. We need to understand that private equity is less liquid. You need to manage your portfolio in terms of a liquid, and you need a liquid bucket. But the absence of private equity, which we've kind of seen in individuals' portfolio, could actually end up in a situation where you're not fully diversified in all the equities that are available to create a well-diversified portfolio.
Now, if we think about adding another piece to the puzzle, private credit. You guys have been investing in private credit. How does it compare to private equity? And obviously, private credit has seen a massive growth the last 5 to 10 years.
And a small bump in the road right now.
Yeah.
So let me take a step back. So what's interesting about private equity and private credit, as we kind of think about how we invest in both those asset classes, it's just a fundamentally different lens that you're looking at. You can look at the same company, but if you're looking at a private credit portfolio at the end of the day, what you're doing is that you're focusing on the assets that are not performing well, and you're spending a disproportionate amount of your time on the 20 or 10% on the watch list, and you're trying to figure out, okay, what are the recovery rates on that? The performing loans, you spend obviously some time on that, but you get comfortable that those are performing loans. And you're spending a disproportionate amount of time on that watch list. When you look at a private equity portfolio, it's almost the opposite. You look at underperforming companies, you can almost say, hey, we're just going to put a 0 on that one. And what you're really focusing on is on the winners at the end of the day and how much, those are going to generate in performance. So I think that it's interesting when things come to investment committee, when you're looking at private credit, you're looking at, the watch list and you're focusing all your time on that. When you're looking at a private equity portfolio, you're focusing on the winners and you're saying, how can those winners compound? So it's a very different lens that you look through. I also think like, look, when you're looking at a private credit portfolio, there is no right tail. So if you lose something, you can't make it up on the other side. In a highly diversified private equity portfolio, if you lose something on this side, you can make it up with upside on the right tail. So they're just fundamentally different in the way that you kind of approach that and the risk return that you kind of analyze these portfolios with.
What about the role of secondaries in the private equity environment?
Ooh, my favorite topic. So I could go on for hours on that one. So I think the secondary market is super interesting because if we go back to talking about, what private equity needs is the GPs need patient 3 to 5 year capital to be able to do what it needs to do with the underlying company. Sometimes it needs to, reduce margins as it invests in a company so that over the long term, it's a better business, right? On the other side, you've got LPs over here that have built built portfolios in different ways, in different markets, and are reacting to it in different ways. So you've got these two ecosystems that essentially have, different objectives at the end of the day. And in the middle of this is the secondary market. And the secondary market, essentially, its role is to inject liquidity into an otherwise illiquid asset class. It allows these two ecosystems to coexist with one another, right? And so there is so much talk about how much the secondary market has grown. And yes, last year we hit another record year, $240 billion. And by the way, that was achieving the prior record year of $162 billion in 2024. And it's been growing at like 40 to 50% a year over the last few years. And people are like, oh my God, like such huge growth. I'm like, 1% of private capital is trading right now, right? The problem with the secondary market is that it is long opportunity, short capital. To put some numbers around that, last year, there was a lot of headlines that said record year for secondaries market ever, fundraising, $165 billion. Great. The missing context is how much was deployed in that year, $240 billion. So what you're seeing is that this is a raise and deploy market. As soon as the capital is raised, it is deployed. It's got less than 1 year of capital. And when you look forward, we have a prediction that the secondary market will get to 300 billion next year. That sounds like a big number from 240 to 300. It's a 25% increase. The only reason why the secondary market isn't going to get to 300 billion, it isn't volume. There's so much pent-up liquidity in the secondary market out there. It is a question of capitalization and a question of resources. That is what's going to constrain growth. So from my perspective, when you start thinking about the secondary market as being the liquidity generator in this market, you start thinking about an opportunity set. Think about an LP. And if you had like a public market portfolio and you invested in it and you did nothing, you never tactically reallocated, never rebalanced for 10 years, probably your committee would be like, what? Like that feels fiduciarily irresponsible. That's what's been happening in private equity. LPs commit to private equity and they hold. Right. And this whole decade right now that we're going through is that LPs are becoming increasingly sophisticated in how they manage their private equity portfolios. So I go through like, the history lesson on the secondary market is that 2000 to 2010 was the decade of institutionalization. The pioneers were established, track records were matured, and institutions started taking notice. But it was all LP secondaries at the end of the day. Everybody was doing the same thing. And it went from $5 billion to $25 billion over that decade. Then in 2010 to 2020, I call that the decade of innovation, right? We went from just doing LP secondaries in the secondary market to levered LP secondaries, GP-leds, single asset continuation funds, multi-asset continuation funds, preferred equity, NAV lending. I think GP stakes, the lines are blurring, private credit secondaries, real estate secondaries. Like there was so much innovation in that 10-year. And the market went from 25 billion to 125 billion, another 5 times increase. But by 2020, the secondary market was long opportunity, short capital. And so what we are in right now is the decade of capitalization, right? We have a prediction that the secondary market get to $1 trillion by 2030. And, there's been a lot of skeptics with regards to our prediction. But what we're saying is that if the role of the secondary market is to inject liquidity in otherwise illiquid asset class, and only 1% of that is trading, and LPs are getting more sophisticated in how they're managing their portfolios and GP-leds. We'll talk about it here in a second in terms of that's not going away. And then you've got all of these other asset classes that are growing, and then you've got innovation within the secondary market. Like for me, it's a question of how do you define a secondary? If you define it in all the ways, if you put in NAV lending, GP stakes, LP secondaries, GP leds, private credit, real estate, preferred equity, definitionally, I think the secondary market has a very good chance. And I've got more conviction than ever that it can get to $1 trillion by 2030.
You obviously referenced GP led. Is that, kind of a temporary response to market conditions, or it sounds like what you said, a permanent feature going forward?
Yeah, so it's so interesting. So you would think based off all the headlines right now that like 90% of exits in private equity are continuation vehicles, right? The answer is, 12.5 to 15%, right? So, and it's been actually growing from about 10 to 15% over the last 2 to 3 years. It's been pretty consistent in that. So a lot of discussion around continuation vehicles, and rightfully so. Anytime there's an innovation in the market, it needs to go through a period of friction as it kind of settles into an acceptable path forward. So you have to have right process, right structure, right mindset. People need to do it for the right reasons. The way that you kill an industry is by doing it for the short term, not the long term. And I'm not saying that the continuation vehicle market was flawless. It was humans. There was lessons learned along the way, but the end state of continuation vehicle, which is to provide a new tool in the tool set for GPs to be able to generate liquidity, I think done in the right way can be beneficial to the industry. So I go back to every time there's an innovation in the markets out there, it's the initial reaction is like we hate it. Sponsor trades back in the early 2000s, LPs were just like, don't love that. Like obviously the first GP's done everything it needs to do with the company, and what's the second GP going to do it? Today, sponsors are kind of well accepted in the market. Sublines, when they first came in, there was a bit of a backlash around sublines, and people were saying like better not to use sublines. To use sublines today, it's an acceptable way of kind of managing a closed-end fund. We got continuation vehicles that are kind of, I would say, like a third to halfway through the journey of being kind of an acceptable way of being able to generate liquidity. But I believe that over the long term, what you're going to see is that about 10 to 20% of exits are going to be done in a continuation vehicle. So 1 in 5 or 1 in 10 exits from GPs, over the long term, will be done through a continuation vehicle, and it's only adding to the list of tool sets. So you have sponsors, you have M&A, you've got IPO, you've got dividend recaps, and you're going to have continuation vehicles. Like if we look at this market today and we said like, where would we be without sponsor-to-sponsor trades in private equity? You would have reduced fairly materially a exit path out of private equity, which is utilized today in a very acceptable format. Right. So I think that over the long term, continuation vehicles are here to stay. They're not going to overwhelm it. They're going to stay between 10 to 20%, probably 10% in a higher liquidity environment, 20% in a lower liquidity environment. But it's providing GPs with a tool that says, hey, I've got an asset. I still like that asset. We've held it for 3 to 5 years. We've done well with it. There's another chapter to come. We'd like to own it versus sell it to a competitor for the next chapter. And I'm going to say the big caveat is as long as it's done with the right process, right structure, right mindset, that the GP is taking care of all the stakeholders along the way, I think that there's a place in the market for these to continue to exist.
If you were an LP today, how would you think about portfolio construction?
Yeah, and I think it goes back to what I was saying a little bit about how private equity portfolios have been managed over the past, I'd say, quarter century, right? As the market has evolved and as these have become bigger and bigger parts of institutional portfolios at the end of the day, there's an opportunity for LPs to be more sophisticated in how they manage their private equity portfolios. And by the way, it's already started. I think in the secondary market, you have a lot of pension plans or large institutional investors that are being a lot more programmatic in the way that they're looking at their private equity portfolios, managing their private equity portfolios, and using the secondaries, LP secondaries, as a mean to just reallocate, rebalance, right? Hey, you might have, and by the way, this is not a rainy day strategy. This is one thing that I want folks to understand. Like, the prior record for secondaries was 2021 in a very high liquidity year. And there were opportunities in 21 where the investor was like, "Hey, I've actually done too well in this part of the portfolio, and I'd like to de-risk." Or, "Hey, my portfolio has moved, more on the mega side, and I'd like to kind of generate some liquidity, reinvest in the mid market," or the other way around, right?
Yeah.
So I just think that as data becomes more available, portfolio understanding of where the portfolio composition is. LPs are going to start getting more sophisticated and saying, "Hey, I want to rebalance. Hey, I kind of have a little bit more conviction in this part of the market versus this part of the market, or I've done well here and I want to rebalance it to here." That's what's going to continue to drive the LP secondary market at the end of the day. So I see a world where the level of sophistication increases materially, and that only provides more tailwinds to the LP secondary market.
So we have just a few minutes left here. I like to ask some fun questions as we look to wrap up. Um, do you have a favorite sports team or a hobby?
Oh my God, sports teams. You got me on that one. Actually, you're surprising me with these questions. So I'm gonna answer my honest answer with this is that I don't like sports. So the
That's
reason
okay.
why
It's
is
by the way, it's not that unique in terms of founders. I've talked to founders over the year. A lot of founders tend to not like, the traditional basketball, baseball. They either like something that's a little bit off the beaten path or they're very active themselves.
yeah. So put me in the bucket of I've been burnt. So I'm from Ottawa. My team was the Ottawa Senators, and they would essentially, like, for a period of time, do amazing in the regular season, then lose in the first round. And I would just like get so emotional, and like just the amount of energy that I was putting towards that. And then my other team, don't ask me why, but was the Seattle Seahawks. And I remember when the Seahawks won the Super Bowl about a decade ago, not the recent one, but about a decade ago. Uh, I was like happy for like 10 minutes, and I was just like, wait a second. So the upside is 10 minutes of happiness for years of misery. One time I kind of decided that that wasn't where I should spend my energy, is on sports. But everybody's got.
Uh, one surprising thing about yourself.
I'm an introvert, and I always kind of like, I'm a social introvert, but 14-year-old Yan was pretty shy. He was socially awkward. I've kind of always leaned into my areas of growth in life, and that was a big area of growth. But at the heart of it, I would say I'm an introvert. I use all of my social energy during the week doing what I do, and then I tend to go into the nature on the weekends. I've got a cottage north of Toronto where I kind of rest and recharge and spend a bit of time in nature, and then come back out for the chaos of what I do during the weeks.
One book that you'd recommend reading.
I love Principles. It's just Ray Dalio's. I love that book. It just provides so much historical content, and really interesting in terms of what the world is going through in this moment.
Most exciting part of your job.
Hmm. I think watching people grow, honestly, just like allowing them to, I think there's a lot of self-limiting beliefs in human beings. And if you can kind of create a safe place for people to spread their wings, that allows them to unleash a lot of potential. So I think that's probably where I would say I've had the most amount of rewards. Um,
And then final question, where do you see the biggest opportunities in private markets the next
I
couple
mean,
of years?
secondaries, obviously. No, I just think, look, I think private markets has established itself. I think we should stop talking about it as an alternative asset class. And I just think we
Yeah.
need to talk about it as an asset class. And there's public and private, and people are always so focused on how much private markets has grown over the last little while. I think it's just getting started. Like, you've got the, high net worth, wave that's come into private markets, and it's going to create some structural changes to this industry, but it's also going to create some challenges and some opportunities. And, I really truly believe the private markets governance model is superior, and it has a place to generate both alpha and diversification in people's portfolios.
I think that's a perfect place to leave it. Yann, thank you very much for your time. I really appreciate it. Continued success to you and the team at Dawson.
Thank you for inviting me on this podcast. Really appreciate those conversations.
Thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.